Tightening in the market precipitated by the interest cap regime as well as uncertainty during the electioneering period saw KCB Group post a stunted growth at 19.7 billion shillings.
At profit before tax level, 2017, we've delivered 29.1 billion, which is flat to the numbers we had in 2016. Bearing in mind that this was the first full year of the interest cap in law in Kenya.
Despite the unpredictable trends, however, the group's balance sheet continued on an upward trajectory, expanding by 9% from 595.2 billion shillings to 646.7 billion shillings, buoyed by, among others, a strong loan book with net loans and advances up by 10% to 423 billion and investment in government securities up by 7% at 110 billion.
We had a decline of about 150 basis points on yields, but we also had a substantial growth of about 10% on the asset book. So from a price volume variance, as accountants would say, net the actual market share growth managed to offset the decline on the yields.
Personal lending was 35% of the total loan book, while the real estate took up 17% and manufacturing taking up 11.4%. During the period under review, foreign exchange income dipped by 15% from 5.5 billion shillings to 4.7 billion, attributed to political uncertainty in South Sudan and Burundi.
South Sudan is the activity on foreign exchange is very scarce. The country is struggling from an FX point of view. You can see in Kenya particularly, we had a 33% growth on that particular line.
However, the group intends to maintain its presence in the 7 countries. Non-performing loans grew by 8.5% in 2017, up from 7% the previous year. Stakeholders are calling for a review on the cap on interest rates in efforts to reduce the cost of risk that the bank pegs at 1.5%.
2.4 doesn't reflect the ultimate potential for growth in the market. So we believe it's the right time, and we support very much what's happening at the central bank and also at the National Treasury. We very much support the review of the interest rate cap.
KCB Group has set aside 900 million shillings to invest in digital financial services.
We are building a new platform. We are building a new mobile payment platform that links our mobiles, especially once transactions have gone into 57% and 20% on the mobile. You need to increase the breadth and bandwidth of your current investment.
The firm incurred a one-off 2 billion shillings expense on account of the reorganization program that saw 316 staff released.
And what is happening is, as you move more transactions on your digital channels, what is happening is that you are getting more space on your staff with the branches. So the view that you will do this restructure once and you're set, this is something that is actually not practical.
The group has proposed a dividend payout of 2 shillings per share.
Obviously, it's subject to approval by the shareholders at the AGM. So putting those together, the two together, though it amounts to a payout of 47% out of our distributable profits and 3 shillings per share.
Regina Manyara Guitar reporting for Business Insights.